Hi folks, Rick Wedell here. I'm the Chief Investment Officer at RFG. Clearly filming on location today. I'm actually in our St. Louis office. Thought we would come to you with a brief market update today, kind of let you know what's going on out there. S&P 500 right at about 5273 as I'm speaking. That's up about 11.2% year to date and within about 1% of its all-time highs. So reaching that all-time highs a couple weeks back. And sold off maybe a little bit, consolidating. We've obviously had a very impressive run since late last year, since about October 27th of last year. Market really kind of consolidating up at these levels. And I think it's worth putting into context so that everyone can kind of understand the market dynamics or the market narrative, sort of the broader history of this market rally. If I go back to sort of the second half of 2023, really the second half of 2022 was when the Fed first started on this journey of raising interest rates to try and cool off and moderate inflation. And it was really in the second half of 2023 that we got this sort of immaculate cooling, this cooling of inflation, despite the fact that the jobs numbers seemed very, very good. Unemployment numbers at least seemed very, very low. Consumer confidence continued to trend higher. GDP growth continued to trend higher. And I think it left a lot of economists kind of scratching their heads a little bit around, hey, where is this cooling and inflation coming from? We'll take it. Don't get me wrong, it's nice to see, but this moderation in price increases really coming despite the fact that we haven't seen a whole lot in terms of actual economic data with much in the way of weakness to it. Fast forward to the first quarter of 2024, we saw that sort of immaculate inflation reduction go away. We saw the return of what I'll call sort of reality in the first quarter of 24, with sort of month over month core inflation prints that were really in that sort of 0.35% to 0.4% range, which is a lot higher than the Fed wants to see. And that sort of put plans on hold. Coming into the year after the immaculate cooling, everyone was sort of calling for the Fed to start cutting interest rates, really kind of aggressively throughout 2024. What we saw in the first quarter put those plans on hold, pushed it out, said, hey, wait a minute, maybe this inflation beast isn't dead. And I think really what the market is looking for right now is a little bit of, okay, what's our next move? Is the Fed being effective in terms of cooling off the economy, or are they not? Really starting to see those expectations of interest rate cuts that are much further out into sort of late this year, September, October, November. Some people even calling for no cuts this year at all, and one forecast or two forecasts that actually put the probability that maybe the Fed has to increase rates. So really kind of a wait and see attitude. And I set all of that up to sort of bring to you the macroeconomic data from today, which is the jobs report. We got the JOLTS, which is the job openings report this morning, which showed about 8.1 million job openings. That's down from 8.4 million in the month before, and off a little bit versus expectations. The quit rate, which is essentially employees leaving their current employment to go seek employment elsewhere, reasonably unchanged versus the prior month. And I would say that this is that the trend here is really the important thing. This jobs report shows a continuation since April of 2022, which is when the Fed started to raise rates, of a gradually cooling labor market, of employers that are less willing to hire, of employees that are less willing to quit and go seek greener pastures elsewhere. And that's important because it is one thing that the Fed can point to say, see, the tightening that we've done on the interest rate side is actually having an effect. Look at the labor market. You can see with whether it's job openings or in that quit rate that the numbers are gradually cooling. And that's important because I think it gives the Fed the confidence that the path that they are on is having an impact. Is it enough for the Fed to actually act and cut rates? No. They're going to have to wait to see that sort of impact on the labor market sort of writ more broadly into broader measures of inflation, see those CPI, those core month-over-month CPI numbers come down. But it is important that it sort of does give the Fed, I think, a little bit of knowledge that what they have done on the interest rate side is having an impact. If they give it enough time, we should see that impact translate over into core inflation. So the rest of this year continues all eyes on the Fed, all eyes on inflation, trying to make sure that we get back down to those core numbers down to the sort of 0.2% month over month numbers that we're looking for. But the reality is that today's report does give the Fed, I think, a little bit of courage to sort of hold the line that they've currently taken, not feel like they need to go even further. And so we'll wait to see those cooling job market numbers show up in broader inflation. With that, as always, if you have any questions, please feel free to reach out to myself or to your advisor. I look forward to talking to you again soon, and I hope you're having a great week.